Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why the ride-sharing company Uber reported better than expected orders last quarter.
Plus, we'll look at earnings from one of the world's biggest producers of heavy machinery, Caterpillar.
First, we begin with the diversified holding company Berkshire Hathaway.
The company recently slashed its stake in Apple by almost 50%. Now, it was part of a massive second quarter selling spree that sent billionaire Warren Buffett's cash pile to a record $276.9 billion.
For more, guest host Jess Metten and I were joined by Matthew Palazola, Bloomberg Intelligence Senior Analyst, Property and Casualty Insurance. And Matthew began by discussing why Buffett may have decided to trim his stake in Apple.
They kind of telegraphed a little bit that they were probably going to sell more at their annual meeting in May. Buffett had warned about tax rates going up potentially in the future and maybe taking some gains off the table. Tim Cook was actually sitting there in the audience. It was kind of funny that they had sold, I think it was like 10 to 13% of their holdings at that time, and they got questions on it. And it just seemed body language wise that they would be selling a little more. So I think tax rates, Buffett's been a little weary on exposure to China for some companies. So I think those two played a big role.
And I actually had mentioned to you before when we were off air, kind of trying to pick your brain, because Apple, if just for people to remind them, it was underperformed the S&P 500 tremendously in the first quarter. It was one of its worst quarters relative to the index, probably like the fourth or fifth worst since the dot-com bubble burst. But then it bottomed in April and has been up close to 30% since then. And so the S&P 500 in that span has only been up about 4%. So you were saying you didn't think even just the rally that we've seen was as much of a factor either as far as why they trimmed their stake.
Yeah, I don't think so. I mean, Warren Buffett's not out there trying to time the market one way or another. He looks at these stock investments as if he's, buying the company. So he also said at the annual meeting he expected Apple to be their biggest holding at the end of this year. It still is. So, I mean, that stock was about 40% of their portfolio before this move. So I'm not surprised to see him take some concentration off.
How much cash do they have at Berkshire Hathaway today? And so any ideas what they might do with it?
Always a tough one, Paul. I think it's $278 billion, which I thought was a mistake when I first saw it because they were at like less than 200 before. The sale of the Apple stake brought in a lot of cash. Higher interest rates have taken a lot of pressure off them holding cash. Yep. I was calculating that just a simple after-tax return on the cash would help their earnings by at least 5% next year, right? So just holding it will be okay. They bought a big stake in Chubb. That would be an interesting mega deal. I'm not really predicting that would happen, but just seeing that, I mean, I think the next deal Buffett does is probably something we don't even really understand what it is, like, makes unique parts for some materials or something like that.
It's interesting too because at a certain point their holding in Apple was so big that it took up basically half of its portfolio. So in your kind of view, does it make sense to make a move like that?
Yeah, I mean, I don't know if anyone wants to have one stock make up, half of their portfolio. He had said he would love to have owned the whole company at one point or something. Also keep in mind, Bank of America was also their second biggest holding. They've been selling a lot of that in the third quarter. So I do think he's really looking at concentration.
I saw some reporting, I think it was in the Times, about Bill Gates and Warren Buffett relationship maybe not as tight as before. Any thoughts there?
So what has been happening is Buffett's part of the Giving Pledge, where he gives away a bunch of his wealth over time. And
I am not. I'm going to spend every last dollar.
I'm not either. I don't have enough wealth to give away. So, but he was giving a lot of his money annually to the Bill Gates Foundation. What happened, I don't remember when it was. I think it was probably the end of last year. He had announced that when he passes away, that his children are going to inherit the shares in a foundation to be used for charity. I think I think before that, the Gates Foundation was, I don't know if it was official, but was at least thought was going to get some of that. I don't know about the relationship between the two of them. I just know that that was the case. And I think, he's given tens of billions to the Gates Foundation over time anyway.
Our thanks to Matthew Palazola, Bloomberg Intelligence Senior Analyst for Property and Casualty Insurance.
We move next to the media and entertainment company Walt Disney.
This week, Disney reported mixed third quarter results, and weakness at its famed theme parks all set its first ever profit in streaming.
For more, we are joined by Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media.
We first asked for Geetha's reaction to Disney's numbers.
As expected, there was weakness in the park segment, but I think what kind of spooking investors is not just the magnitude. So they had expected kind of flattish profits for the quarter that they just reported. They actually reported a 3% profit decline. But I think what is more disconcerting is that they expect to see kind of this lingering weakness in the park segment. So they're saying a mid-single digit operating income decline again in the next quarter. And they expect the softness to last out a few more quarters. So obviously the consumer is not going to come back in a big way for at least another 3-4 quarters. And I think that is definitely creating some nervousness.
Did I tell you I canceled my Disney trip?
Whoa, there
I did.
There
I was
goes.
like, you know what? I don't want to spend $6,000 on this.
Really?
And I wasn't even like going anywhere fancy. I was just like, this is ridiculous for 4 days.
No kidding.
Yeah.
Did
you
you
know.
Did you tell your daughter this?
I didn't tell her we were going to begin with.
Oh, good.
So I really
Yeah, so-
saved myself on that one.
Yes.
But Geetha, we know that the consumer is slowing, right? We got that from Comcast, for example, and their parks. But they made a profit in streaming. I mean, come on. Isn't that what we really care about?
That is. Streaming profitability has been a big focus. They have turned the corner, and it's obviously going to continue to be a big earnings growth driver. Remember, just yesterday, they actually raised prices, or they're planning to raise prices across all of their streaming tiers, including as much as a 25% hike on their ad-supported tier. So, this is going to become a significant earnings growth driver going forward. And then one of the things that we've really been complaining about with Disney, and I think investors have also been a little bit worried about, has been kind of their content engine. But they're really kind of back with a bang. So, obviously they had the huge success of Inside Out 2 in the quarter that they just reported. And then now you have Marvel's Deadpool and Wolverine, which I think is your favorite, Alex. And that's
Yeah, it is.
So, Geetha, going back to Alex's point, I mean, if somebody like an Alex Steele cancels a Disney theme park trip concerned about price, is there a fundamental concern that Disney's just kind of outpriced themselves out of the market, that they're starting to hurt demand?
Yeah, that definitely is a huge concern right now, Paul. And so I think what we're going to see is they obviously are not going to be able to raise prices. We were seeing something like a 40% increase in per capita spending, across the parks for many, many quarters. But I think what they kind of did was they over forecasted demand and under forecasted the reversal from that pent up pandemic demand. And so that is what we really are going to see play out over the next few quarters. Having said that, though, I mean, yes, the domestic park business is going to see some softness, but they do have the cruise business, which obviously is going to take off in a big way. They have 3 new ships that are coming on board over, the next few quarters. So they are expecting some of that softness in the domestic parks to kind of get offset. But again, it's going to be kind of a wait and see.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media.
We move to earnings from America's leading health solutions company, CVS Health.
This week, CVS lowered its 2024 earnings outlook for the 3rd straight quarter.
The company also announced cost-cutting measures to save $2 billion over several years. This comes as healthcare costs continue to soar.
For more, we are joined by Jonathan Palmer, Bloomberg Intelligence Senior Healthcare Analyst, and we first asked him for his take on CVS's quarterly results.
Yeah, so this is the 3rd consecutive downward revision to earnings, and it started with 4Q earnings, then 1Q, then 2Q, and really it all comes back to higher medical costs. And so if you think about CVS, there's 3 legs to the stool here. There's the Aetna business, which is their big insurer. There's a PBM, Caremark, and the pharmacy that we all think about. The pharmacy's stable. There's some pressure on consumer. The PBM's doing pretty well, but the medical business, the benefits business, is seeing all these revisions downward as people are visiting their doctor more.
So basically, this is like if I own CVS Medical, I go to my doctor, I pay my $40 copay or whatever, and then they bill CVS for that.
Well, so the insurer, this is on the Medicare side, the Medicare Advantage
okay.
plan.
Mm-hmm.
So a lot more seniors are visiting their doctors. And that trend, we saw it at the end of last year, and we thought it would maybe subside by the midpoint of this year. But it's still elevated going into the back half, and it's causing a lot of trouble for CVS.
But, I was going to say, but don't they get reimbursed by the government? Like, how does that work, though?
Well, so the way the plans work is they bid a certain amount, and then that's how they get paid. And so if the trend's higher, they don't make quite as much money based on what they bid initially on the plans.
So what can the company do to kind of
so there's a couple things they can do. They can exit markets. They can ratchet down the benefits that they're providing. So Medicare Advantage is a little bit different than traditional Medicare in that they can offer things like dental and vision. They can ratchet some of those extra benefits down. But it takes time because these are planned cycles. So like we won't see any benefit until next year.
This is like the whole issue with people living longer, right? Like you have people living longer, they're on Medicare, right? And then this is kind of what happens. How do we solve for this though long term? How does a company solve for this longer term?
Yeah, I think it's getting a better handle around the trends and how they price their offering. Interestingly enough, CVS just let go the executive who was in charge of this benefits unit, and the CEO and CFO are stepping in to run the day-to-day. So there's a lot of work to be done and a lot of wood to chop there.
Maybe a dumb question. Who are CVS's competitors, considering they're in so many businesses?
Well, on the pharmacy side, it's Walgreens, it's Walmart, it's Costco. On the PBM side, it's Cigna's Express Scripts, United Health's Optum, and then it's the whole smattering of insurers from Humana to United Health, Cigna, Elevance.
Political risk, Jonathan. I know your industry cares who's in the White House, who's in Congress. What's the feeling from the healthcare space?
Yeah, we generally, our regulatory analyst in Washington, Dwayne Wright, doesn't see too much risk through this election cycle. You know, everybody talks about drug prices. Biden put in the IRA. That's come to pass. There's a lot of saber rattling around PBMs, but usually nothing actually happens at the end of the day. It's more about the headline risk there. So we're not too worried about the regulatory landscape going into the election cycle.
What's the best part of your space? What's the name or the area that people are most enthused about?
Yeah, so on the healthcare technology side, there's a lot of interest there. You know, AI's kind of creeped into everything, and there was recently an IPO of a company called Tempus AI that does diagnostics and provides data to drug manufacturers. So they're kind of marrying those two data sets in a very interesting way.
Our thanks to Jonathan Palmer, Bloomberg Intelligence Senior Healthcare Analyst.
Coming up, we're going to break down why Google recently lost an antitrust lawsuit in the U.S.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go in the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move now to earnings from the ride-sharing company Uber Technologies.
Uber reported better than expected orders in the second quarter, with continued strength in demand for rideshare and delivery services.
For more, we are joined by Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst.
We first asked Mandeep for his key takeaways from Uber's results.
Good print, solid top-line growth. I think the fact that we are talking about a business that's generating $40 billion run rate in a year, I mean, clearly they have the scale. The question for me when it comes to Uber 5 years down the line, you know, long-term play, how disrupted their business model is going to be from the rollout of autonomous vehicles and robotaxis. And it's not the right time to talk about it, but when you look at Waymo and how successful they've been in the 3 cities that they have launched, I mean, the part of the call was about how Uber is integrating Waymo inside their app.
What is Waymo?
Waymo is Google's autonomous driving unit. I mean, they have about 300 cars in San Francisco, similarly in a couple of other cities, Arizona. And what they have shown is their technology is ready for prime time. I mean, they have to get regulatory approvals to do it at scale. But that changes the unit economics completely. Right now, we are talking about a business model where cost per mile is like $5 to $7. Waymo can, at scale, they can do it 3 or 4 times cheaper. So suddenly the take rate model gets disrupted. Now, again, it's not hit prime time, but that's what Tesla is striving for. And the risk for Uber and Lyft is they will get disintermediated.
Okay, so It's not the fact that Uber would just go get a bunch of robo-taxis and use them, and eventually that would pay off over time because they're not paying drivers. It's not that scenario.
It's not that scenario because both these companies want to roll out the robo-taxis themselves as opposed to using an Uber. And even if Uber was to get involved, their take rates would be way lower than 30%. Right now, they are getting 30% of every ride. Let's say it's a $50 ride. Uber makes at least 30%. That's a pretty healthy take rate. Autonomous driving equation, first Tesla wants to go solo. They don't want to partner with any of the ride-sharing guys. That's one risk. Waymo is on Uber, but my sense is they also want to kind of broaden out their reach and they will deploy the technology themselves. And in fact, Alphabet allocated $5 billion in CapEx this quarter on Waymo's rollout. So,
all right. All right, it's bad enough that I get in a car with somebody I've never met, a total stranger. That's crazy enough to think about. Am I getting in a car that's a robo-taxi? Is that really going to be a thing, and if so, when?
These vehicles are monitored. So
By the way, I have a Vespa scooter, by the way, so I don't necessarily need them for the shore, but go ahead.
But just go to San Francisco right now. You can order a Waymo ride.
You can?
You can. Wow. And just get that experience. I think every consumer who has taken a Waymo ride loves that experience.
Really?
Uber talked about, they acknowledged the threat on their call, but they also think the rollout will be slow, and they are positioning themselves by seeking all these partnerships. They're partnering with BYD for 100,000 vehicles. That was big news last week.
Well, then why would it be exclusionary? Like if Tesla rolls it out themselves, it just means more competition. It doesn't mean it's exclusionary. Like with Lyft, like you guys price compare with Lyft, there's room for more than just one.
There is, but then it goes back to being the scale player and having that 30% take rates. The reason why Uber has done much better than Lyft is because it's a scale player. And it can charge that 30% take rate because it has the liquidity in its marketplace, the supply-demand matching, the best ETAs, the most options that it can offer to its riders. So like marketplaces are all about scale. The moment you have more than 3 or 4 competitors, right now it's a duopoly, and still we see how badly Lyft is doing relative to Uber. If you have more competition, that's not good news. But again, this is further out. This quarter was solid. Nothing goes wrong for Uber until this robo-taxi rollout plays out. So we're talking a few quarters out scenario.
Market cap for Uber, $132 billion. Market cap for Lyft, $4 billion. What happened?
Well, Uber clearly has the scale, and DoorDash has done similarly very well on the food delivery side. So you've got 2 scale players when it comes to ride sharing and food delivery, and they have the most supply. One challenge with this business model is gross margins can never be as attractive as your software companies.
Yep.
And that's what we keep finding with Uber. It's like they're still a 40% gross margin business at an aggregate level.
Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst.
We move to big tech and Google. This week, a U.S. District Court judge ruled that Google illegally monopolized the search market through exclusive deals.
This handed the U.S. government a win in its first major antitrust case against a tech giant in more than 2 decades.
For more, we're joined by Jennifer Rhee, a Bloomberg Intelligence Senior Litigation Analyst.
We first asked Jen to explain what exactly the accusation against Google was.
Google basically was found to be a monopolist in general search services. And I think that's probably no surprise, right? We all use Google. I think they have 80 or 90% of the search queries in market share. But specifically, what was found to be illegal was Google paying many other third parties, including Apple, Mozilla, Samsung, other OEMs, to set Google search as the default search engine at all the access points that, where you need to access the internet. So for instance, behind a browser, behind Mozilla Firefox, or behind Apple Safari. And so what the judge said is, well, by placing Google as the default, this really blocks out all the other competitors, the search engine competitors. And at the end of the day, they can't get better if they can't get to customers, because search engines get better based on the number of searches done. And Google's got all those searches locked up. And that was anti-competitive because it was exclusionary and probably hindered innovation, might have hindered choice, and possibly hindered quality.
Are there some remedies that might be really onerous on Google?
The remedies have yet to be hashed out. And, that process could take 6 months. It could take even another year before we know what they are. And then Google will likely appeal and can seek to stay any remedy pending the appeal. And if that happens, you're looking at several years before there's any impact at all. But at the end of the day, the remedies could be onerous. First of all, the DOJ will seek structural change. I don't think they could win it here, but one of the requests they might have of the judge is to break apart parts of Google's business.
Wow.
Again, I think that's a long shot here. I don't think it'll happen. I think it's more likely that what the judge will say is, Google, you can't pay anymore to have that default position. And maybe the judge will say, Google, you have to share some of your data with some of these other search engines, or maybe some other new nascent search engine that comes into being after this remedy phase is finished.
Okay, so if that's the case, I wonder, does this change if President Trump wins the White House, or is this kind of like locked in?
You know, it's such an interesting issue right now, Alex, because one might have said if an administration changes from Democratic to Republican, it could change, and there might be more of a likelihood of a settlement. But you have J.D. Vance as former President Trump's vice presidential pick, and he actually is aligned with the idea of breaking up Google. He's pretty anti-big tech. I don't know how much he would influence the policy decisions of a Trump, DOJ, or FTC, but if he did, he would be all in on continuing to go after Google. So I think that possibility of some kind of a settlement that's easier on Google happening down the road is low.
Jen, I think if you stopped any person on the street, they would say, I got no problem with Google. Actually, it's great. It's changed my life for the better. Is this one of those issues where it's a solution in search of a problem here? And does that factor into remedies?
You know, exactly. You're thinking like a lawyer now, because
that hurt.
There's a lot of commentary when this case was brought that the DOJ brought the case, but they really don't have a solution, and they brought it before they knew what the solution would be. We're going to get into what they're going to suggest the solution, but Paul, exactly why you said, you know, people love Google. And this is exactly why I think the judge wouldn't do something structural, because he's not going to want to mess that up. People like Google. Google's essentially a free product, at least for people, not for advertisers. And it functions very well. And despite having a monopoly position, the judge did acknowledge that Google continues to innovate in the search area. So I think because of the desirability for consumers of the Google search engine, we're not going to see something structural. But I do think, obviously, the judge is going to have to impose some remedy because he found that the company is acting anti-competitively.
This is a weirdly unfair question to ask you. Is big tech too big? Like, do we have a big tech problem?
Well, I think that's what the current administration thinks, yes. But, you know, there's a disalignment here with our Supreme Court, because our Supreme Court has ruled over and over that it's not illegal in the United States to have a monopoly. And in fact, that's what we want all companies to work toward, because that's what will cause them to innovate and try to gain market share by lowering their prices. So at the end of the day, just being big isn't illegal. The problem is the conduct of a company that's really big. Right. And that's really what the DOJ and FTC are going after right now.
How about other tech companies? What does this mean for them?
You know, I think it's atmospherics because there are different facts, different issues, different markets, and different market positions. You know, the case against Amazon, against Meta, case against Apple, they're quite different. And these cases rest on the facts and the specifics. But what this does do, at least for Google, we have one more case coming up, a big one against its ad tech stack. That's going to trial this September. And now Google's been found to have monopolized two different parts of its business, its Play Store and now search. So psychologically, you know, it could influence a judge to think, well, they've been found to engage anti-competitively in two areas. Why not in a third as well?
You know, Paul, this goes to your area, too. I was reading that big tech's AI problem is just going to buy smaller companies and getting their talent, right?
Right.
And I wonder if that has to kind of go away now, because if you have this kind of DOJ.
Yeah, it's interesting. I mean, I think what I understand from people like Jen is that some of these big tech companies, their hands are really tied in terms of big deals, at least.
Yeah. Jen, do you think?
Oh, absolutely. Their hands have been tied for the last 3 years. Things could change a little bit with the new administration. I think there is no doubt, no matter who's elected, there will be some change in the leadership positions, the decision makers at the Department of Justice and Federal Trade Commission, and that could change things. But I do think big tech is still going to have a lot of trouble going forward trying to do any kind of a big deal.
Our thanks to Jennifer Reed, Bloomberg Intelligence Senior Litigation Analyst.
Coming up on the program, a conversation with the CEO of Energy Vault on storing energy.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to Caterpillar, one of the world's biggest producers of heavy machinery.
The company is seen as a bellwether for industrial activity, and this week Caterpillar reported second quarter earnings that showed resilience. That's despite growing worries about the global economy. To help recap, we were joined by Christopher Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst. We first asked Chris what he made of Caterpillar's most recent quarter.
I think there are a lot of positives to take away from this report, and I think investors could probably, breathe a little sigh of relief. The margins were really quite impressive. I mean, they were up more than 100 basis points, even with the softer top line this quarter, with better than expected profitability, really across all of its businesses, with particular strength in the energy and transportation unit. Again, that really continues to be a big driver for them. We saw dealer inventories come down kind of a little bit more than we normally seasonally would, which is a positive sign. And then also the backlog improved sequentially, which I think will probably help alleviate some of those fears around a more severe slowdown and inventory build, which has been a big concern among investors.
Chris, talk about geography. Are there any pockets of strength or notable weakness around the world?
Yeah, so if you think, Europe has been weak for CAT for quite some time. We're starting to hear of some potential green shoots over there, but, I think CAT kind of dispelled some of those, that it's a little too early for talk of a recovery there. So kind of bouncing along the bottom. China obviously continues to be at pretty depressed levels. Historically, China's been 5 to 10% of consolidated revenue at CAT. Will be well below that 5% lower end of the band this year. And then North America, while some of the retail numbers this quarter were a little bit softer than they had anticipated, particularly with some of the rental dealers not maybe restocking as much as they had anticipated, that continues to probably be the most resilient area of the business for Caterpillar this year. But I'd also call out, actually, Latin America was surprisingly strong this quarter on the back of Brazil.
So how much visibility does a company like Caterpillar have, Chris? And what are they saying about their visibility?
Yeah, so the backlog increased sequentially here, about 2.5% in the quarter. We're almost at $29 billion. That gives them roughly, 3 months of coverage, a little bit longer, with longer lead time products like some of the energy and transportation products. Those have much longer lead time, but think of it as roughly 3 months. Orders did come down a touch in the quarter, but we saw some sequential improvement there. No signs of really kind of a more precipitous decline, which I think has been a concern, just given some of the prints that we've seen from some other machinery names that really brought down their construction outlooks for the year. That really doesn't seem to be the case here.
So that's sort of their top line. How did they manage their cost profile, margins, etc.?
Margins were phenomenal, and I think that's the big takeaway. Yeah, I mean, if you look at energy and transportation, one, pricing continues to be the biggest driver of the margin performance for the enterprise overall. But if you look into the energy and transportation unit, margins well ahead of the street. That is pricing and a little bit favorable mix. You also have lower freight costs. You have lower material costs. Execution here continues to be quite good. So I'd expect that strength really to continue throughout the balance of the year. And as you alluded to earlier, while Caterpillar doesn't give explicit guidance, they're basically telling us that this year is going to be a lot stronger than they had anticipated, with margins above their long-term framework. Earnings are going to be stronger than they had anticipated, even coming into the quarter. So certainly the margin performance it was quite good.
Chris, how about the competitive landscape out there? Who does CAT compete with, and how's that share game going globally?
It's there's a number of regional players, Komatsu being the biggest one over in Japan, but they're a big competitor here in the United States, particularly on the mining side, but also construction. You have Volvo, CNH Industrial, and then obviously Deere here in the United States that kind of round out more of the local construction peers. There's a number of other players in Asia, whether it be a Hitachi and a few others. But it's really, Caterpillar is the market leader. And really, if you think about mining, it's essentially a duopoly in the mining truck business with them and Komatsu.
When we take a look at what Caterpillar tracks, like I'm thinking, I like looking at it because it feels like a nice global growth barometer. Is it a global growth barometer? Like if earnings grow at Caterpillar and their outlook is good, does that mean the global GDP is good? What's your correlation for that?
Yeah, no, you're absolutely right. It is a global economic bellwether. Half the business is still here in North America, but you think of it roughly 20% EMEA and 20% Asia, and then Latin America, like I said, down around roughly 10% of the business. But it certainly is a bellwether for economic growth, and North America continues to be probably one of the more resilient regions globally because of all this infrastructure spending that we have. That has certainly kind of offset some of the weakness on the commercial side of the business. And then obviously it seems like we're, kind of approaching a bottom on the residential side. So maybe that provides a tailwind as we move into 25.
Our thanks to Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst.
Let's move now to my favorite space, energy. So how to store energy is huge, because if you want to diversify what energy you're using, like wind, solar, and hydrogen, you really need big batteries to be able to store it. And storing energy for long periods of time has proved to be very difficult and expensive.
One company that's trying to change that is Energy Vault, NYSE ticker NRGV. Earlier this week, we were joined by Energy Vault CEO Rob Piconi, and we first asked Rob to describe what exactly his company does.
We broadly focus on energy storage, and we focus on it with varying technologies and software. So we do shorter duration energy storage using lithium ion. We do long duration energy storage, meaning things that get sort of in the 6, 8, 12, even 24 hours. So full day types of storage with a unique gravity solution where we lift and lower blocks, or we'll shift water from different heights. And we also do ultra long duration, meaning multi-day storage using green hydrogen and microgrids.
Who are your customers, Rob?
Our main customers are first and foremost utilities. So we can sell directly to utilities, and we also sell to independent power producers. So the ones that will, for example, build out solar or wind and pair storage with that and have long-term contracts with utilities. And the third group are the large industrial users. So our investors include people like Saudi Aramco, BHP, the largest mining group in the world, and groups that are looking to make their own clean energy transition, or that have desires to make green hydrogen, for example, where you can make that using solar, an electrolyzer, but you need long duration storage. So because our technologies focus across a series of durations, we can actually meet a lot of those needs, and hence serving those three market segments.
So let's go back to the gravity storage solution thing. So this is from an article here at Bloomberg from a few years ago, but it describes it, and I feel like accurately and pretty well. An electric crane hoists up blocks of concrete and stacks them into a tower when power is plentiful. When power is needed, it uses gravity to take the structure apart brick by brick, and the weight of the descending blocks converts kinetic energy into electricity. That sounds really hard and complicated.
You know what? Gravity's been around for a while. I tell people it's not an idea, it's the law. So the whole physics of moving weights up and down has been around. But you're right, to do that in a way that's economical, to do that now with software where we can automate that entire process and dynamically look at the timing and dynamically accelerate that lifting and lowering. And also, we actually don't use concrete. So we avoid it because it's not really sustainable. It's one of the contributors, I think, 7 to 8% to greenhouse gases. So we actually have a material science team and worked with Cemex to use dirt and even waste materials like coal ash, even concrete debris, other things that would go into landfills. We can utilize that to make these large blocks that are 25 metric tons. So we try and avoid materials that are not sustainable to make those very same blocks.
So how is, I guess, your business changing to try to meet the changing sources and uses of energy these days?
It's a great question, and it is one of the challenges. It's definitely focused globally on countries wanting to achieve energy independence, and to do that, you need to be able to produce locally. Hence, our gravity solution, that's more long duration, of course, is ideal because you can produce most of that from local materials, local labor. I mean, it's construction, you're building a building. When you get to the short duration, which is most of the market today, and we know about lithium ion, so that's 2 to 4 hours, that's this time shifting people trying to manage. You're relying on the rare earth metals, which I believe, Paul, is what you're referring to. And that's where, through mechanisms like the IRA that was put in place in the US, they're trying to get that localized. And to deal with that, you have to come up with mechanisms to try to bring some of that production local as much as you can in terms of getting content. And that's been a big focus area, and of leveraging technologies like hydrogen, for example. Green hydrogen can be made sustainably. We're using that to back up the city of Calistoga in Northern California near Napa to provide a sustainable backup solution for 2 to 4 days that otherwise would have taken natural gas. So it's a combination of technologies you really have to use to solve this issue of reliance on either a few countries in the world or a few rare earth metals.
So if I just look at your stock, it's had a tough road since its SPAC, right? I mean, clearly there was a lot of enthusiasm in the beginning. You had a nice pop, and then it's been really tough. In the last earnings for second quarter, the headline is revenue missing estimates. How do you manage this at this time? It's expensive to probably get all this done, even though the demand we know is still there.
Yeah, the demand is high, and the capital markets have been very challenging. In particular, if you go back to mid-2022, when the interest rate environment changed, and really fundamentally, I think the risk appetite for new emerging growth companies like ours really soured and changed. And for us, we focused on execution, and we had 148 million in our first year of revenue, 2022. Our second year, almost 350 million. So we more than doubled the size of the company. But at the end, investors are really focused on cash flow and minimizing risk. We've guided that that's going to happen next year. So in our third full year of revenue, we're going to be cash flow positive and EBITDA positive. And I think until that happens, a lot of investors are on the sidelines. And what we can do is what we're doing, which is executing for customers and in different regions of the world. We announced new deals in Australia. We announced a large gravity project in Italy at a coal mine. And I think filling up that order book, Alex, is going to be fundamental. So investors see it's not about if, it's just about when. And as we fill that order book, then when that cash flow roadmap becomes very clear, which we're getting there to 2025, which is what we guided, I think then we'll see investors re-entering the stock.
That was Energy Vault CEO Rob Piconi.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.